If you own a business, I know it's so different than if you're just, belonging to a company and you're putting in your IRA or your 401.
Yeah, so retirement account contributions are something that I think there's a little bit of a misconception as to what they are. They don't avoid taxes, they defer taxes. And so the idea is you get money that you're earning now, you can tuck it away into a retirement account. And what happens is it reduces your income currently, but in the future, when you start to take it out, it'll increase your income. And so you're just shifting your income in that particular case. So when you own a business or if you have a high income situation, you can push some of the income to future years where hopefully tax rates might be lower for you, or your situation, your income situation might put you into a lower tax bracket. And so it's a concept that it's a good idea to contribute to it if you think your situation in the future is going to be such that your tax rate is going to be lower. In most cases, it will be because we're in a pretty high tax rate scenario right now. Probably in the last 100 years, we're at the highest tax rates that we've ever been. And so the anticipation is tax rates may go down, maybe some various cuts to tax laws and so on and so forth. So deferring that income to a future year is not a bad idea. There's also the idea that you've got the concept of the time value of money. A dollar today saved is worth a lot more than a dollar in the future that you might save. So if you're deferring income at current rates and pushing it to future, you may have a little bit of a tax benefit there. There's some caveats though that you have to be concerned about with deferring money to a retirement account. First, once you put it into a retirement account, you're kind of putting it into a lockbox, and so you can't touch that money without penalty until you're 59 and a half years old. So if it's money that's purely discretionary and you don't need it, you can do it and defer it, you're fine. But if it's money that you might have to tap into, there might be other vehicles that are worthwhile. So that's one consideration, because if you take the money out before the 59 and a half, there's a pretty stiff penalty, and you don't want to pay any extra than you need to on that. So when you consider funding retirement accounts, there's a lot of different factors in play. Your current scenario is important. Your discretionary income, your future tax rates, all play into the consideration as to what and how much you should do. There are also multiple types of retirement accounts that you can fund. When you own a business, you have access to certainly an IRA. You might have a 401k. There could be cash balance plans. They all have different levels of funding, and they all have different restrictions and potentially matching that the company can do. So, for example, you might have a 401k plan where you contribute a certain percentage of your income, and then the company can match a certain percentage of your salary, giving you an extra benefit. So there's different ways to add money to these retirement accounts, fund them at greater levels than you might typically do when you own a business.
If you are midlife and you're able to put in a little bit more, or maybe the kids are off to college and you're done paying for them and you're still working, then maybe you're going to put in a little bit more. What is your advice to your clients regarding how much they decide to put into a 401 year to year?
I think it's important, Jody, that you look at whether or not a company offers a match. And if they offer a match, try to take advantage of the maximum amount that the company will match, because that's free money to you in essence. The company's giving you a benefit. And when you own a business, you have the ability to kind of take some of the profits and push it to yourself in the form of a company match as well. So that's a big consideration for funding a 401k plan, for example, is how much match can you get, because that's just bonus money to you. Right. Certainly your life situation is going to dictate how much you can contribute. And like, as you mentioned, when you're younger, a lot more expenses, funding kids' education, just kind of buying that house and getting established. You might not have as much discretionary money to put into a 401k. And then, of course, you also have the consideration that once you put it in there, you can't touch it for a long time. So earlier, it might be more challenging to contribute to it. But if you have the discretionary money and it's truly discretionary, it's not a bad move. As you get later in life, once you get more established and have potentially higher earnings or potential that you've got, then you might be able to put more money into a 401k and kind of get it jump started. Certainly at certain age levels, when you get to 50, you can actually put extra into it. And so typically people in that age might have more discretionary income, so they can go to the extra funding of a 401k and put money into it. So, lots of ways to put it in. Again, it's reducing your taxable income in the current year and deferring that to a later year. So if you're a high income earning person right now and you want to drive down what you owe currently, you can push it to the future and maybe spread that out into later years where you might not be earning as much income. And so therefore you could be in a lower tax bracket and could have some tax savings as well.